Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.
What's up, guys? Mr. Fit to Flourish here. Today I wanted to talk about some things you need to understand when trading options and what are some qualities of good option contracts. Let's get right into it. So, number one, what are options? Options are pretty much contracts. They're insurance on a stock, okay? So it's like buying insurance on a stock. And they're pretty much these assets, they're wasting assets. And what happens is you buy them and you're betting on a direction. So if you buy calls, and in this video, I'm only going to be talking about going long calls. So buying calls or buying puts, going long puts, going long calls. Okay. We're not talking about strategies of like strangles, iron condors, all that BS. All right. We're talking about just straight up buying calls and puts, because that's usually what most people want to do, because it's the simplest strategy and it's the most lucrative strategy. Right? So when you're buying calls, you're betting that the stock price is going to go up. So going up would be 110 to 115 to 120 to 125 to 130 to 135. Okay. And then if you're buying puts, you're betting that the stock is going to be going down. Going down is 125 to 120 to 115. All right. Obviously. Now you need to understand the nomenclature. All right. And the nomenclature would be something like, okay, calls. Out of the money calls is if the stock price is currently at 125. Out of the money strike prices would be if you bought a contract that you're betting that it's going to go to at least 130. All right, that's your strike price. Your strike price 135, 140. All right, that's out of the money. But if we already passed the price, then that's it. That's considered in the money. If you're betting on calls, you're betting the stock is going to go up. Okay? And it's just the opposite for puts. So if the stock price is currently 125 and you're betting the stock is going down, so in the money would be the prices we already passed on the way down. Out of the money is prices we have not hit yet on the way down. Okay, so think about it like that. Now, what are some qualities? What are qualities of good options? All right. So when it comes to options, you need to understand the Greeks. So number one, your delta, you want to have a big delta. What is delta? So delta tells you how much your option contract will increase or decrease in value, basically increase in value with a $1 change in the share price. What does that mean? So for instance, delta, if you buy a call option for 0.5 or $50, okay, remember when you're trading options, it'll on the options chain, it'll say like, oh, 0.5, but you have to understand that an option contract gives you control over a block of 100 shares. Okay, so you multiply by the option multiplier, which is 100. So 0.5 is actually 50. So if you buy a call option for 0.5, which is $50, and the delta is 0.25, which is $25, then that is a delta to contract price ratio of 50%, because your delta is 25 and your contract is 50. So that ratio is 50%. Which is really good, which means that for every dollar move, if we're buying calls, then we're betting the stock is going up. So for every dollar move that the stock goes up, so from 100, this is the stock price from 100 to 101, our contract just went from $50 to $75, because delta tells me how much my contract price is going to go up. For every dollar move, we go in the upward direction on calls. Okay, and then from 101 to 102, it'll go from 75 to 100. So in just a $2 move, we gained 100%. Okay, so when I'm looking at option contracts, I'm looking at my delta, and I'm looking to see, hey, what is the delta to my contract price ratio? And this is pretty strictly for day trading. For swing trading, I'll still look at the ratio, but essentially for swing trades, you'll want to push out your contract's expiration date further out based on the expected move. Okay, but I'm talking strictly about like some of the Greeks and things that people don't consider when day trading or swing trading. You need to consider your delta. How much money are you going to gain for every dollar move? Okay, this is literally the main thing to look at. I really don't. People are like, data is the most important. Data is not important. Depending on how long you anticipate that move to take place. Okay, gamma is not important. All right, but theta is your pay to play. So okay, let's talk about theta. So theta tells you how much your contract will decrease in value for every day you hold that option contract. Okay, so it doesn't matter if you're day trading. If you're holding a stock for more than a day, then we're going to look at theta. But if you're day trading, theta doesn't matter. I'm telling you right now, theta doesn't matter. People are like, oh, theta, because you guys don't trade. You guys don't trade options. You don't trade options. Theta does not matter unless you're holding an option longer than a day. Okay, and in that case, pay attention to your theta. It's going to tell you how much value you're losing daily. All right. So theta does matter if you're swing trading. If you're holding a stock longer than a day, it's going to tell you. All right. So what do you do then? What do? You determine. All right. You got to determine when you're trading options. You got to determine how long do you anticipate that it's going to take for the expected move. All right. What do I mean? So what I mean by that is, get to NVIDIA. So here on NVIDIA, I am expecting, NVIDIA on this chart. Okay, this is the daily time frame. I'm expecting NVIDIA to get to this gap here. All right, let's hide all this other stuff. I'm expecting NVIDIA to go from this $130 level to $140. I'm expecting that to happen in about 3 to 4 days. Okay. And based on how many days I anticipate that move to happen, I literally pick my expiration based on that. So if it's 3 to 4 days for this move to happen, I'm going to pick an option contract 2 to 3 weeks out. So you want to give your option contract enough time to get there. Okay, to get there. And I usually pick out of the money contracts. Why do I pick out of the money contracts? Out of the money contracts are more volatile, and their delta to contract price ratios are usually more significant, and they're less expensive. Okay, so I'm looking for less expensive option contracts. Now you can always get in the money contracts because they'll always have intrinsic value. But I like out of the money because it's very volatile, and if we do get the anticipated move, they gain so much money extremely quickly. Okay, and what does theta look like? So theta looks like this. So pretend that the stock price is at $100 and it just doesn't change for 3 days. The stock price just stays at 100. So if theta is negative 0.1, and we buy that contract again, we buy the contract for $50. So day one, our contract's $50, and we hold it. We hold it for a day. Day two, our contract goes down to $40 because theta was negative 0.1. And then on day three, our contract goes down to $30. And that's just if the stock price doesn't change, okay? But that's an example of how theta works. I just realized I wasn't sharing that screen, but basically this is what it looks like. So day one, $50. Day two goes to $40. Day three goes to $30. My bad, I wasn't sharing that screen. Okay, and then besides delta and theta, literally the only important thing when you're looking at an option contract is the IV. The IV is the implied volatility. Now, why is that important? If the IV is over 50% and you're holding your trade overnight, you're swing trading, it's not good. Okay, just know it's not good. You don't want an IV over 50% if you're swing trading. If it's over 50% for a day trade, that's fine, because you won't get that dramatic of a change. But the IV is the implied volatility, and it's the volatility of an option based on what the market believes that the option is worth in real time. And usually when you get closer to earnings, that IV will spike up over 100%. Over 100% is no good because basically you'll get something called IV crush, and that's when you're holding an option contract overnight, and it's the IV was over 100%, and you bought the contract for $400, and then the event happens, and after the event, the IV just goes back down, right? The implied volatility goes back down. So the IV adds a lot of value into a stock, volatility into the stock, of the option. So once the event takes place, then it's like, oh, okay, the event happened. All right, there's no more volatility. The true price of the option comes. So then after you paid $400. The next day, the stock didn't really move too much. That $400 goes to $10 because the implied volatility was really big. So the implied volatility can add a lot of fluff to option contract prices, which is why you want to stay away from option contracts if you're swing trading, you're holding it overnight. Stay away from option contracts with volatilities over 50, okay, over 50%. IV over 50%. You want to kind of stay away from those because the higher the IV, the more fluff and fake value there is in your option contracts, okay? So think of it like that, the more fluff there is. So for instance, if a contract is supposed to be that $50 contract and the IV is over 100%, that $50 contract is probably going to be like $370 when we know it's supposed to really only be $50. But that implied volatility adds a lot of fluff. And why do we get that volatility? It's because people are going to be willing to pay more money for that option contract due to the surrounding circumstances. Like earnings is coming up, so an event is going to happen. They're like, oh man, I want to get in. I'll get in at any price. Okay, so that causes volatility to increase and inflate the price of these option contracts. Right? So pay attention to IV as well. All right, so those are some things to pay attention to. All right, and then like I said, when we're choosing options, your weekly options, they expire on Fridays. Monthly options are the name of options that expire on the third Friday of the month. And then options like zero DTE options, which are options that expire the same day. They can be traded on IWM, SPY, and QQQ, and some other ETFs, but they allow for you to day trade. And the fact that they expire the same day makes them extremely volatile and pretty dangerous sometimes to trade. The only time that you want to day trade 0 day to expiration options is when there's clear opportunity. What do I mean by that? Well, on this day here, let's show an example. So on this day here, like in this section here, it looks like just a lot of non-trend bars, a lot of bars just going sideways. You don't want to trade 0 DTE here, all right? You'll want to trade 0 DTE on breakouts. And what does a breakout look like? A breakout looks like this. You have a clear low, and then you have your 15-minute range. You have a clear high here, so low and a high. And we start getting these big bullish moves to the upside. And then we get our volume RSI, our momentum indicator, showing a big move up. Then you probably want to enter on 0 DTE contracts here because there's an opportunity for a breakout, a fast move. So the only time you want to trade 0 DTE is when there's an obvious fast move in one direction or the other. Other than that, pick further out expirations because it won't decay. Your option contract price won't decay as quickly as a 0 day to expiration contract. Right. But yeah, that's going to be all I'm going to share for today in today's video. If you have any questions on options or something you want to see on option contracts or options, let me know and I'll go into more detail. But hopefully this helps. It's your boy, Mr. Fit to Flourish. I'm out.